Good evening and assalamu alaikum everybody. I'm happy to be here again. This is my annual knowledge zakat to the IIBI. So it probably is less than 2.5% of my teaching load now, so maybe I need to do more. But inshallah, I'm sure Farida will take care of that. What we want to talk about today is probably over 30 years of reflection on my part as to what kind of home finance we can have in this country, which is true to the maqasid rather than the form of the Sharia. Because we want to achieve certain objectives, and I see developments in both banking, provision, and technology which can make it possible. Previously, obviously, we had lots of banking regulation restrictions in what we wanted to do, especially in terms of products which were sharing risks. But now I have found a lot of banks which are willing to do things which we did not think were possible. Also, a lot of schemes, public sector schemes, which have come in for equity sharing schemes. So I think we have now a possibility within the law in this country to do things which are quite different. And we have some very interesting propositions coming up. My friend from Castle Trust is here. I will mention some of the ideas they have, whether we can expand on those ideas in terms of actually sharing the risk of home ownership. The backdrop to home ownership in this country is obviously there is a great demand for homes. There's a great demand for affordable homes as well. There is an increasing level of unaffordability. Plus, overriding this is that if you look at 60, maybe 70 years of statistics on home ownership here, you see that there has always been an underlying real increase of 2 to 3% a year, despite the ups and downs. I'm looking at real, not nominal. So there is a capital gain element always there, and over 25 years that could be quite a substantial gain. So we need to find solutions which are able to capture that gain and offer it as a discount or a service to the buyer rather than leave it out. Okay? Let us see now. The first one is that in terms of home finance, the most prevalent product in the market is what we call a conventional repayment mortgage. We used to have endowment mortgages and things, but with investment returns as they are, they have gone by the wayside. Conventional repayment mortgage is the most common. Typical 25-year term. Again, typical up to 95% loan to value, but could be less. And in fact, all the recent government efforts has been to push loan to value to 95%. We have obviously those lending is based on income multiples of either one person working or a couple working. And after that, it is essentially a loan contract. The bank gives you a loan to buy a house. The house is yours. You keep the title deed as collateral. If you pay off the loan and you make a capital gain, it's for you to keep. The bank has no call on it. If on the other hand, unfortunately, if you suffer what is called negative equity, either through during the term or in a process of default, because the bank has nothing to do with the house, the outstanding borrowing still is your liability, and essentially they can come after your other assets. Okay? So this is a loan contract. Bank is essentially a loan provider. The home is only a collateral. And obviously, we don't have time to go into how subprime came about and so on, but this model if you up the loan to valuation to 140% as Yorkshire Building Society did, then clearly you have issues. Or there is a lot of what we call self-certified lending. So your income is not verified. You just say, I make so much, and they give you a loan. So but those are risk elements which is up to the regulator to sort out. So this is a typical contract. Now, if you imagine this contract, when we started to think about this process about 20, 25 years ago, you want to replicate this as an Islamic finance contract. You want to replicate a loan contract into a buy and sell contract. And you have challenges there. So what have we come back with? Okay, this becomes our reverse engineering benchmark for Islamic home finance. Yeah? And most of the problems we get in Islamic finance is because we reverse engineer from an existing product to see how we can replicate that product in an Islamic framework. And in history, as Professor Farooqi has mentioned, we have like 4 different formulations, and we will look at the most common. But the first formulation was by Al-Ahli Bank. This was an essentially murabaha contract, fixed rate, full term, so 25 years fixed term mortgage equivalent. So obviously cost plus sale, or 25 years, because it's a sale contract, if you break it anywhere in the middle, you are liable for the full amount. And I don't think murabaha is suitable for a long-term contract, all right? Unless you have provisions for rebate and gifts back and so on. But contractually, you cannot put anything like that. So very soon, they found out that that is not working. It was too expensive as well. In fact, the number of people who took out that Al-Ahli offering was in the 50s, even not in the hundreds. It was a very, very difficult contract to plug. Then you had the next lot who figured out that if you do an ijara, the bank buys and does an ijara on the thing, you might be at the end of the period, you will then obviously offer to sell that. The ijara contract provides you a rental term, but it doesn't say anything about sharing of gain or loss. It's a fixed rental contract. Yeah. After that, when that was also difficult to run, people came up with a formulation of diminishing musharaka, which is a diminishing ownership contract. So you buy jointly with the bank, and as you pay full rental, the amount you own becomes part of your purchase of the shares of the bank. So essentially, it behaves exactly like the repayment mortgage. If you look at the substance, it behaves exactly like that. The problem with this was that if you are in a situation of capital gain, for example, 5 years into the thing you want to sell the house, you have made a capital gain, and say you still have only 40% of the property, the bank has 60%, technically the capital gain has to be shared 60-40. What the bank did was to say, we will forgive you our part, we will forego our part of the gain, and you can keep it just to replicate the repayment contract. However, if you are in negative equity, now the bank cannot ask you to forgive your and put up part of the loss. And there is no way they could force you because they are 60% owners. So there, they've done some engineering with our Sharia scholars and mixed musharaka and ijara to make sure that you neither share the gain nor the loss. So it becomes exactly like the repayment mortgage. And that is one of the problems and challenges we have, that this product has got nothing new other than substituting a rental for an interest payment. Even the ownership doesn't actually bring any benefits or disadvantages to the borrower or the lender. On top of that, you have a number of other problems, right, which have come in. One, how do you fix the rental? Technically, you should have a rental, which is the market value of the rental. But as you can see, for the same property, you have different rates in rental rates in different parts of the country. So if you borrow 100,000 in London, you might get one rate, and if you borrow 100,000 in Manchester, you get another rate, and so on. Clearly, there is a lot of room for arbitrage there, and no bank is willing to do that kind of thing. So what they have done is that they have said, we will fix the rental by reference to LIBOR. Nothing to do with the house value, with the house location, with the actual rental value. There is no link to the rental value. 100,000 home finance in London will give you exactly the same cost as 100,000 in inner city Bradford, for example. So in terms of really maqasid, this is not taking us very far, yeah? It is compliant in form, but it's not taking us really into anything which we feel happy about. So people like Ansar Housing, they have figured that out and said this is not a true product. Doesn't share capital gain, loss, doesn't have even a rental idea. But even to fix that product, it took us quite a bit of doing. Because when you are converting a loan contract into a buy and sell, you had this issue of double stamp duty, which we worked with the governor of the Bank of England at that time, the late Eddie George, and changed the Finance Act in 2005, I think, changed that, and made sure that the two contracts were considered as one for stamp duty purposes. Because in the buy and sell contract, the bank buys, sells it back to you. There are two sales. In the normal loan contract, there's only one sale. So otherwise, you would be at a disadvantage of up to 3.5% stamp duty. And then those were followed by STLT changes in other things. Okay, so that was needed in legislation. There was needed. There are other issues which also came. For example, council house tenants had a right to buy their homes at a discount. If you get the bank to buy, and the bank doesn't pass on the 40% discount to you, you have issues. So that needed to be fixed. It hasn't been fixed in law, but it's fixed informally. Third issue, if you become unemployed and are not able to pay your mortgage in a conventional mortgage, the benefits will pick up your interest payments to keep your mortgage current, right? Now, the law says interest payments. So if a Muslim having this contract is only paying rent, he has no entitled or she has no entitlement to benefit payments on unemployment. So that had to be fixed. It's not fixed contractually in law now, still informal arrangements with local authorities. So anyway, with these bells and whistles, we fixed that contract, but it is, as you can see, compliant in form. Technically compliant with the law here, with Sharia scholars and everything, but spirit-wise, is it doing anything different, anything new? Not really. So this product, obviously, are offered by Al Ahli Bank, as we said, then ABC, HSBC Amana, which did quite a number of them before they withdrew from the market. In fact, at one point, their loan book was about $1 billion in the UK, so about 4,000 houses, roughly. Lloyds TSB, which was using a white-labeled ABC product. United Bank of Pakistan, again, very small, but they dabbled into it. Islamic Bank of Britain, which is now coming into it, essentially a very similar program, diminishing Mushara stroke Ijara. And Ansar Housing, as I said, very pure cooperative pooled product. So you have to become part of a cooperative, and each member in turn gets financing for their house and so on. So that's a organic growth model, which is not scalable fast and will take a long time, even if people subscribe to it. Now, in the meantime, these are all the things I have already mentioned. Yeah. In the UK, we have the evolution of other things. After the failure of endowment mortgages or endowment mis-selling, we have this dominant model of repayment mortgage. But because of affordability, first beginning with the Labour government, they introduced a certain number of equity sharing products. This meant that key workers, for example, were able to get up to 50% of their homes as shared equity with the government. Now, shared equity was exactly what we would want to see in an Islamic finance product. You share the gain, you share the loss, you don't pay any rent on it. When you sell or you want to buy that equity, you buy it at current value. So if it is negative, the government loses. If it is positive, you lose, or you have to pay more. As I said, on average, because there is a 3% real gain on property prices, the government wouldn't stand to lose much on average, okay? So equity sharing schemes were for key workers. Even now, the recent product Help to Buy, the uplift from 75 to 95% is an equity share contribution from government. So it's a very technically compliant product. And in equity share, a gain and loss is shared either way. Now, I have over the last 8 years probably taught about 500 students, and every year to the MBA students and others, they want a project to do. So I've been giving them a choice of one project on home finance. So you're going to scratch your brains. If you put a product which shares both the loss and gain from day one, and input your 3% or 2.5% real home finance gain, what kind of product will come out? Will a bank be able to reduce your initial charge by 2.5%, which is the real gain they are expecting, or 2% to allow for some risk? If you assume that, that product is much superior to any repayment mortgage product you have here. And you can model it, and I have got lots of students who have modeled it, come with the same answer. Both the lender and the buyer will benefit. And it's much closer to what we would expect a Sharia product to do. It still doesn't solve the rental calculation problem, right? Because that's still LIBOR. And then the Ijara element, and then 6 months revaluation according to LIBOR, and so on. So it's very near the conventional product. On the other hand, there are also other products which have come. So one recent introduction has been by a group called Castle Trust. What they are saying is that if we they will put up to 20% of equity as risk-sharing equity. And in return, they will take 40% of the capital gain. Am I correct? Yeah. So you don't pay anything on your 20%. When you sell or when it crystallizes, you pay 40% of the capital gain. Any capital loss, obviously, they will take it. Now, this is much closer to the spirit we are looking at. So they are arguing, of course, they are not looking at a full 100% product. They are arguing 20%. They are arguing that if you put 20% or 10% deposit, they bring this 20%, so it becomes affordable on day one, because you don't have a repayment on that, and then you borrow 70% as you like. So a product becomes affordable, becomes the repayment flow in the early years is much more bearable. Now, we want to see that can we find with these schemes a way to structure a product which is closer to what we are saying. I think that mixing this model of sharing capital gain, mixing the loss and profit sharing for the balance of the 70%, we can arrive at much better products than what we have within the regulations which are possible in this country, within the banking regulations as well. We don't have to go outside banking regulations. However, the problem of rental will not be solved. So we are still short of a product which satisfies people. I ask people over and over who have taken this product, they say, one Nigerian brother, he said, you know, the smell of LIBOR, I don't like. I said, but it's not LIBOR, it's only benchmark. He said, I don't like the smell. I'm not satisfied. Somebody else says the inflexibility in the product, I don't like, and so on. So they are still unhappy. And does it bring more affordability or use any characteristics of the community here? I don't think so. I think it's only compliant in form. So what can we do? Let's look at a Muslim community profile. Yeah? We have a community where we still have quite significant links within families. Yeah. So you have your uncles, you have this, and some of them are better off than others and so on, and willing to help. The problem with helping here is that, for example, if my son or daughter wants to buy a house, I'm happy to give him or her some money, but I want to make sure that I have access to it when I need it, and I'm not stuck, right? How to square that circle, I will show you, and it's possible. Or my friends, my uncles, some of them may be happy to help, give a helping hand to a product. And there are lots of things which, if can be done without taking on credit risk, they will do. Yes, so we were working on this Sharia product with Lloyds Bank, and trying to make this what I described as a proper product. And then there was a lady there. She was Asian. She said to me, "Have you looked at this one?" I said, "What?" She said, "This product is offered by Cheltenham and Gloucester Building Society, which was part of Lloyd and still is. And this is much better than all this crap you are talking about." She wasn't Muslim, but she's very frank to me. I said, "Fine, show me." So it works basically on an offset plan, right? You know that there are lots of offsets available which essentially allow you to reduce your repayments or interest payments if you have parallel money sitting in your account. So if you have 20,000 sitting on 100,000 borrowing, you won't pay interest on the 20,000. If you match 100 to 100, you won't pay anything. What will happen then is that whatever you pay will be capital repayment. No interest payment or no rental payments or whatever. In that case, your 25-year loan will be fully paid in about 10.5 years. So if you are able to match the two sides, you are really in for a good thing. However, not many people are borrowing who have the same amount of money sitting idle. Yeah, otherwise they would buy the house with that. So Cheltenham and Gloucester at that time started what is called and was called a friends and family offset. Up to 8 or 10 friends or family members can link their accounts to your account and provide you the offset. So if I have 100,000 and I have 10 nice friends and uncles, each putting 10,000, I don't pay anything. They don't get any interest on their money, and I don't pay interest on my borrowing. I will pay it back in 10 years. The borrowing is mine, credit risk is mine. What they give is not tied if they can withdraw anytime. So now you've solved that problem. You've mobilized surplus money. You've not tied it for them, so they are free to take it wherever you have. And your borrowing, your repayment is about 10 years. Okay? So I did that for my daughter. She came to me and said, Dad, I don't want to borrow on interest. I want to do an Islamic home finance. I said, no. She said, what are you talking about? You are teaching Islamic finance and you are telling me not to take this. I said, I show you a better product. So we did that. So I said, the upside is that you're not paying interest. Your friends and family are not paying interest. Your only downside, which is not really a downside, is that you got to keep smiling at all of them, right? And inviting them for dinner or something so that they don't withdraw the money. Or you have one or two in spare who can come in if somebody needs the money for whatever reason, right? So this one works quite well. It mobilizes the money. It really reduces the risk. And if you see a young person borrowing and being able to be outside of a mortgage in 10 years, it's much better than 25. When your family is beginning to grow, you have a completely free property on your hands. And I think it's in this direction, which is now, obviously it's a credit loan agreement. So if the time you have less money, you'll be charged interest. So it's not a Sharia product in that sense. But if you look at the maqasid, what you are trying to achieve, you are getting here a much more affordable product. You are getting here something which actually reduces the repayment term significantly and brings you within the kind of social parameters you want, that families, by the time they have children, they have no borrowing on their homes, etc. And you are achieving so many other things. So I want you to put the two sides together. A Sharia compliant product in form, full of all those issues, or here, a product which effectively doesn't need you to pay or receive interest, but within a loan contract. With that, you can also mix and match other equity sharing programs if you want, so that you can build a product which really reflects the profile of the Muslim community and the wealth structure distribution, the younger population which needs to be on the housing, get access to housing without compromising your Sharia. Shelton and Gloucester has stopped this product, but some others are still doing it. I think Yorkshire Building Society is still doing it. NatWest is doing it. They are not very keen to. They are not promoting it very keenly now, but it's there. However, it doesn't stop, for example, somebody like IBB to launch this product. It gives you 10 customers for every product. You can cross-sell whatever else you want to them. It mobilizes money, and it identifies you as a genuine provider of something which fulfills the maqasid. What else an entity like IBB would want? Why should it stick to a repayment mortgage replica? They have to have offered some value in the market. So, to end, I summarize that when we were working with the World Bank was saying that our overarching objective is poverty reduction. We're saying, yes, fine, but show us what poverty have you reduced. You're going into all this. The first two paragraphs in any project will say poverty reduction and all the nice words like you have your CSR reports in accounting and so on, but underneath it. So after a long struggle, we managed to push this idea of the MDGs, Millennium Development Goals, which are now targets saying by 2015, X number of people, young children in schools, X, Y, Z. Now every World Bank project has to make an estimate of how it will contribute to the MDG. So it becomes a focused thing. What we need to do in Islamic finance similarly is that every activity we do, we need to be able to say how it will contribute to the maqasid. not how it will duplicate something in the market. If it was that, we would rather stick to the market. We want to do something more. And I think this kind of thinking, this is of course only possible with new technology, right? Multiple accounts, multiple linking and all that is now possible. So, and since a big bank is doing, there should be no regulatory hurdles. Other groups are bringing equity sharing like Castle Trust, which is funded by Jesse Flowers, Fowlers or Flowers? Flowers, yeah. Who are not charity. They are private equity investors. So they can see the potential in that. So I think we don't have really a leg to stand on if we say we cannot do more than what we are doing. I rest my case. Assalamu alaikum.
Thank you.